So for those of you who don't know me, I'm Dror Berman. I'm one of the founding partners of Innovation Endeavors. And for those of you who don't know us, we're an early stage venture capital firm, actually based in Israel and Silicon Valley, now New York. We're very focused on what we call the super evolution of industry, essentially looking at how deep technologies are coming together to transform large underserved markets. And I've been doing that for, well, basically since 2009. So it's been a fun evolution, actually, not just investing personally, but also seeing how the ecosystem has changed significantly over this period of time. We were just talking before the session, and there were some arguments that it's probably the biggest change over the last, 30 or 50 years that we are seeing now. So Yasmin thought it would be a good idea to actually organize a panel to discuss that, and all those people here, they're going to introduce themselves in a second, graciously agreed to come. Some of them actually from Japan, and most of them are from Silicon Valley, to share their wisdom with us. We're going to do it very interactively. So the idea, we have about 3 topics that we're going to discuss and lead a discussion about, and then feel free to jump in, ask questions. And this is supposed to be a roundtable, not a panel. So feel free to jump in. So with that, maybe we're going to do quick introductions and then dive into the first topic.
Thanks, Dror. I'm Maurice Werdegar, Western Technology Investment, WTI. I'd like to acknowledge my partner, Jay Cohan, here in the audience. We're a 38-year-old venture debt firm. So if you've ever heard of venture debt, it was invented by our founders in the early 1980s. It's taken on a lot of different life forms over that evolution. We're in our 9th fund today. We're an institutional fund. We've invested in about 1,100 companies. We're very active in the Israeli community and have about 20 portfolio companies there, and then across the US and other parts of the world. And in a nutshell, we provide a layer of debt capital on top of equity that entrepreneurs raise to help their money last longer and go further between one round to the next, seed and A and B, et cetera. We also do some small equity investments alongside that, and we're very proud to be here. So thanks for inviting us.
Hi, my name is Lydia, Jett. I'm with Softbank, and in particular the Softbank Vision Fund. So Softbank is a large Japanese corporate entity which has a bunch of operating businesses. But more recently, over the last year and a half, we've launched our first institutional funds, and Softbank Vision Fund 1 is the fund we're investing out of right now, which is a $100 billion capital fund. We make a minimum of $100 million investments into the largest global technology companies disrupting the largest industries. And I'm happy to talk about that further.
Hi, I'm Rob Siegel. I'm the extreme opposite end of Lydia. We're a seed investor. Her minimum investment is twice the size of our current fund. We're a boutique seed investor where we make initial investments at about $1 million in companies that have deep technology, usually as a differentiator. A lot of stuff here in the Valley. We have invested in Israeli companies in the past, actually 2. One that just got acquired and one that we just made an investment. And our job is really to be a feeder fund to the other funds up here. We've done multiple deals with Maurice, and I used to co-teach with one of Dror's partners, Scott Brady, at Stanford.
Hi, everyone. My name is Saar. For this audience, I'll tell you I was born in Pittsburgh, Pennsylvania, and my parents are Israeli, so you guys don't have to keep asking me the same question, but I don't speak Hebrew well. I'm at a firm called CRV, or Charles River Ventures. The firm has been around almost forever in terms of the history of venture capital. We're investing out of our 17th fund, no thanks to me. I joined about 10 or 11 years ago, and most of what I do is focus on consumer investments. Our fund currently is about $600 million, and we mostly do Series A, about 80%. And I was trying to think about, we do make investments that are as small as a few $100,000. I'd say consistently we tend to invest in companies that are quite young, meaning often within a year of incorporation.
Yeah, somewhat weird to talk to a microphone. So clearly this is a diverse set of investors. We have anything from seed investors all the way to SoftBank, and in between Saar doing Series A, B now, Maurice doing venture debt. I'd love to just maybe sort of as a first topic dive into your engagement with entrepreneurs and really understand, as entrepreneurs are thinking about approaching you, how should they think about it? What should be the best way to engage you? what would you be looking for sort of as a certain baseline, certain KPIs as you're evaluating different investments? And what should they expect as they go through the process with you?
I'll start. I think for us right now, I'm currently spending a lot of time in what I would call post-product pre-traction. Would be what I would call early. So in consumer, historically, we've done a lot of pre-product things, and I think we've, as the seed ecosystem has just gotten so much more mature, kind of moved up a bit. And in terms of engaging with us, I think that we tend to follow certain theses and areas that we like. So it can be difficult to get our attention if you're just in an area that actually we're just not that interested in. It's not about you. It may not be about your business. It's just if we don't like the market, we're likely not going to engage. So I would say being creative on how to maybe get us excited about a market may be a way to get us engaged. Otherwise, if you're in one of our lanes and sweet spots, then we generally like to follow teams and get to know them over some period of time. But we spend a lot of time meeting with folks pretty early on.
For us, companies, we'll see them before CRV, so maybe there's a prototype, maybe some customer engagement, but generally the product's not done. There may or may not be revenues. At this moment in time, we are very unthesis driven, with the exception of looking largely at the machine intelligence space where we've been investing for the last 6 years. Our thesis is that most of the horizontal solutions in that space will be aggregated to the infrastructure providers, Amazon, Google et al., and people need to have vertical solutions that not only reduce costs but that add value to customers. Right now, because we're in a transition on platforms, we think most of the economic rents of mobile and SaaS have already been collected, that it becomes more acutely important to follow the entrepreneur. And it's always true that you want to follow the entrepreneur, but that's especially important now where it's very, very volatile and no one really knows what's coming next. When we look to size a seed round, we're looking for an entrepreneur where he or she can hit specific milestones that mitigate technical risk, execution risk, and market risk. So we look to try to size a round that hits certain achievements, not where they're going to spend the money, but where the entrepreneurs are going to achieve milestones that mitigate risk points. We want to help them fund to that and build a syndicate, put in a buffer because it always takes longer and costs more than you think. And then our role is to be very engaged, but we don't use the phrase hands-on. We're coaches, we're not players. Our job is to help our entrepreneurs make original mistakes, not the mistakes we all made when we ran companies, and then be a feeder fund to the larger funds.
So as I mentioned, SoftBank is only about 1.5 years into this experiment of the Vision Fund, but it is in many ways replicating what we've been doing for 30 years, or what Moss has been doing for 30 years, which is investing in global internet companies. What we've been trying to think about as a team is how do we do something differentiated relative to the market? And for us, that is very deeply where can we add value? And can we add value through our existing SoftBank portfolio of owned operating assets, which are some of the biggest distribution assets globally? Can we do it through the portfolio of assets we have minority holdings in? Can we do it through operating expertise because we operate very large businesses? Can we do it through capital? Can we do it through strategy? But because we're seeking to add outsized value, we care very deeply about assets having synergy between them, which is why we care a lot about the thesis, the sectors, where we can have real density of asset and thought. And so if you look at where we have great density today, it's in assets like mobility, or sorry, I should say sectors like mobility. So we are the largest holder globally of ride-sharing assets between Uber and Didi, Ola, Grab, and a couple smaller assets. We're the largest holder globally in horizontal e-commerce platforms. Flipkart no longer, but Coupang, Tokopedia, Fanatics. We're probably the biggest conglomerate globally in areas like robotics and AI, more so in real estate technology today. And so if you can show SoftBank that we can add real value to your business through plugging into our ecosystem, it becomes significantly more interesting to us. I think the other thing that we're thinking a lot about, given the assets and experience and knowledge that we have around the table, is how do we help take the best businesses in any particular large geography, a business that's been proven out, so very different than what these two are talking about. You not only have product and you not only have some demand, you've got the team, you're a clear number one in your market, you've got a business model that works. How do we help you go take that globally? And so we've been doing that very actively There's a company that a year ago was only operational in India, and today is now the biggest operator in scale in China, in the UK, in Dubai, and that's happened over the last 6 months. You look at WeWork, which I'm sure most of you are familiar with. We're helping to operate JVs around Asia. So we're trying to find ways that we can help grow platforms in an explosive manner, and that explains why we put so much capital against assets. We're not trying to do what other venture capitalists are doing, which is to help you win in one market. We're trying to help you win in all markets. And so that hopefully is an explanation for why outsized capital is being given to these assets in a way that raises some questions here in the Valley.
Can I just following up on that, and clearly you're sort of the newest in the market, but also probably the most disruptive. You mentioned that it's important you have a thesis around certain markets, and you're thinking about how can you add value. Is there sort of any specific baseline you're looking at, like any specific revenue run rate that, given it's a $100 billion fund, you need to deploy a lot of capital? Or would you invest in sort of anything seed stage or very early on if it fits your thesis?
Yeah, so we can't write checks smaller than $100 million definitionally in our operating agreement, and so that is a limitation. We like to write larger checks than that. The average check size in this fund is $1 billion, and so the vast majority of what we do is very late stage. But there will be instances where we will invest in much earlier stage companies because we believe that they plug so significantly into our existing assets. And then you can find us sometimes playing in maybe a Series B with a $100 million check, which maybe has some tranching. But we really don't want to be at the bottom end of that spectrum because it's not a good use of our time. We're not a big team. I think very differently than probably what you all experience. I'm working with 4 to 6 portfolio companies at a time. I'm not going to work with 40 because I'm spending a ton of time with each company. So if you just think about how many assets we should have, we can't have a lot of $100 million checks. We need to have $1 billion checks.
That's an easy story to follow. We intersect with companies at all stages. WTI, as a venture debt firm, we do about 100, 150 deals a year, and that can be a complementary layer of debt capital on top of a seed round, an A round, or later stage. So we'll write debt checks of as small as $500,000 and as large as $75 million. We recently did our largest deal ever with Eventbrite, which went public about 2 weeks ago, in order for them to make an acquisition. It was acquisition financing of the Ticketfly division of Pandora. They didn't want to raise equity to do it. They were getting ready to go public. They didn't want another share price nor the dilution. So we can span the entire gamut, and we're the exact opposite of focused, I guess you'd say. We're generalists. We're looking for great management teams who come to us with a use case as to why supplemental capital will make a difference in hitting key inflection points and milestones in their business that'll help them raise money at a higher valuation, potentially from better investors down the road. So we're usually intersecting with companies that have raised a round from one of these investors, not Softbank. We haven't funded after you yet. And perhaps spent a quarter or 2 or 3 of that money and have had successes and learned a lot about their product market fit, perhaps about their customers, and are working on some key developments like a partnership or some key management hires or other things that take money, require time, and ultimately shorten the runway before that next round. And I think that one of the things we've learned is that companies go out and raise 18 months of cash typically often forget that you have to start raising your next round about 9 months after you've just raised that round, because you need to have at least 9 months of cash in the bank to look like you're doing something preemptively and proactively on the fundraising trail. And that's a pretty short time frame to grow into that valuation you just raised, and you're probably behind plan. And we supplement that by adding 2 quarters of time, really. And it's a modest layer of debt. It's proportioned to the round size and to where you are in your stage, but it can be extraordinarily impactful in giving you the ability to continue to execute, keep your head down, make the right decisions to grow the business, and then ultimately raise a very successful round. And we're very proud to have worked with all the investors in this room, and SoftBank's come in on a couple of our companies after us, so we're happy to work with you too.
It's still working together.
So, by the way, if there are any questions, feel free to jump in. But there'll be more time later on as well. So maybe jumping into the more interesting topic we wanted to discuss, which is really what's going on, right? We talked a little bit about SoftBank, but I think that's part of somewhat of a larger trend that happened over the last 5 to 10 years of sort of the creation of mega funds, whether it's SoftBank with sort of $100 billion for now, and I think the next fund is going to be, 3, 4, or 500 billion. But also, look at funds like NEA and Sequoia, and there's probably 10, 20 firms in the Valley that raised $1 billion plus funds. And I think that we've done, 5 investments, or five or six portfolio companies actually got investments from SoftBank. And one of the outcomes, at least with my portfolio, is that everybody is expecting that the next round will be $100 million round from SoftBank, even if they're really, really early in terms of progress. So I think that's sort of one trend. I would love to get your opinion. There is sort of a variety of investors and stages here about what's really going on and how should you think about it as an entrepreneur, think about raising money down the line. Similarly, I think there is a lot of concern. Actually, I think since I started investing in 2009-10, there's been a constant concern that we're in a bubble and everything is going to burst next month. And I get this question a lot from entrepreneurs of what's going on. How should this macroeconomy impact me? Should I go out and raise money? And together with that, there is a lot more opportunity to actually raise money more aggressively. For inorganic growth, for acquisitions, and so on. So how do you advise your entrepreneurs to prepare for this environment currently?
I'll take the first one. Yeah. Let's talk about Lydia. I could think back in my life on some of the dumbest things I've ever said. And one of them was about 18 months ago. I was giving an interview to the Wall Street Journal, and they said, what do you think the impact is of the Vision Fund? And I said, it's only going to impact the high end. It's not going to impact the mid and low end. We're going to see it's going to squeeze out all of the hedge funds and everything else. And that was one of the dumbest things I've ever said in my whole life. The impact of what SoftBank is doing has had secondary and tertiary effects that we're only starting to see now. Not only are they able to help their portfolio companies and separate from the herd, but more importantly, we're seeing the reactions of the other large funds, as Dror mentioned, of them raising multi-billion-dollar funds because they have to keep up. And if they've got a winning company in their portfolio, they want to make sure they can hold on to it as long as they can. That's impacting the LP base on a global basis. And we see it, from strategics, pension funds, et cetera, many of whom couldn't get into the larger funds and are now having the opportunity to do so. And we're even seeing family offices on a global basis that are now driving to a lot of the larger funds. And so I think it kind of is what it is. Josh Lerner at Harvard predicted after the first internet bubble that we would see a consolidation in venture, much like we saw in the investment banking business. And it's possible we're seeing that right now here. And so what you'll see is an incredible concentration of very, very large companies that will have the capital and resources to go global quickly and scale in ways that couldn't be done before. And the only people who might be able to fund them will be the larger funds. And the question, I think, for entrepreneurs is, if you're in the very, very early stages, how are you going to go from that initial step of 2 people and a dog to scaling at that kind of speed and scale? And I think that's still being worked out. But I think this is a non-traditional and a structural change of what we're seeing in venture, the likes of which we've never seen before.
It's interesting because I don't spend enough time in the Valley. Our purview is very global. I was sharing with Dror, I've been in Tokyo 7 times in the past 3 months. So there's a lot of time spent outside the Valley. And I work with a lot of global companies. And so I probably don't hear as much of the drumbeat here in the Valley as what you're experiencing in terms of the impact of SoftBank. But at the same time, I don't know that I've ever seen such an explosion of first-time funds. All of these venerable venture capital funds in the Valley are separating. And you've got GPs going out and raising their own funds and raising significant funds. And so I guess the counter argument to the fact that there is a real consolidation of capital in these big funds is I see the same thing happening on the other end of the spectrum. And I think the other thing that I see on a day-to-day basis is just the explosion of capital that wants to be investing in tech for very good reason. And I think the best example of that I've seen recently was Ant Financial did a large fundraising. Sequoia Capital's done a large fundraising. You're talking about people who are asking for minimum $200 million checks and getting pages of people who can write $200 million checks. So I think the opportunity size of what's happening in tech and disruption and big industries is drawing a shitload of capital into these industries. But I don't think it's just pulling at the top end. I think the bottom end is having a significant explosion as well.
So my data doesn't come from just from the Valley. Given my work at Stanford, I get to see global Fortune 50 companies from all over the world and seeing how they're being impacted by this. And by the way, I don't have any value judgment on whether this is good or bad. In terms of funds that are breaking up, let's see if those new funds raise second, third, and fourth funds. I think it's,
How do you think it should impact entrepreneurs, right? Like, when you
Right.
think about debt environment.
I think an entrepreneur, you're going to have to figure out how to nail product market fit very quickly and have a plan to scale quickly. Because I think that the large funds and the good funds, even if you think of CRV as a mid-step between kind of the seed and the very, very big funds and even IE, right? You're going to have a plan to figure out if Masa looks at you and says, if I gave you $200 million, what would you do with it? You better have an answer. And all the way back, if the larger fund, for somebody to say that they're going to have a $20 million seed or a $20 million Series A, that's a joke. It's an absolute joke. But that's the world that we're living in today. And so I think entrepreneurs need to be thinking about if the long-term big game players are thinking about how do they deploy that much capital, you better know what you're going to do with it and how you'd be able to get global quickly so that Lydia can say, yeah, I want to bet on that entrepreneur.
If you haven't been in Rob Siegel's class at Stanford Business School, I have. It's phenomenal to watch him take the stage. At least he doesn't have any opinions. We think that there's an alternative way. I think a lot of companies are going to go the SoftBank route, but I think that 95% of them are not. And that the role we play in the ecosystem, and that I think much of the venture ecosystem is still surviving and evolving around, is being capital efficient, executing well on a vision, building a good business, and then having a good outcome. Because I think there's going to be a lot of roll-ups, a lot of interesting things that are built. I see our good friend Pratish over there at Servant Ventures nodding his head, and he's building great SaaS businesses. And so I think as much as it's important to know what to do when SoftBank knocks on the door, for most of you, they probably won't. And it's not bad. You may actually end up owning a much higher percentage of your company, having a quicker exit, and having a different path. And the role we try to play in that ecosystem as a coach, as well as capital, is to be very thoughtful about the rounds you raise. And I think that your comments about big Series A's, we agree with. We think staying capital efficient, lightweight, giving optionality to yourself, not raising too much money, being a bit hungry throughout every step of the way is what's been the time-proven way to build some real value. And of course, options become more available, but the notion that you have to go big, fast right away is quite dangerous and reminds me of being at the very end of a cycle, actually, which is kind of how it feels that we're at right here today.
I couldn't agree with your assessment more, by the way.
I'm putting that on my resume.
No, I mean, I think the SoftBank vision is an extraordinary thing we can bring to a specific subset of companies, but it is the wrong path for the vast majority of companies. And so it's why I'm kind of surprised with how much it gets talked about in the Valley, because the SoftBank application should only be made to 100 companies, not thousands. And for the rest of companies, the decisions that you're making, your range of options is so much higher if you don't go the SoftBank route in terms of what is a successful outcome. How do you determine your own path? It's a very different path to go SoftBank. And so I think the last message that any of us at SoftBank are trying to give is we want everyone to come to us. We want very specific assets who deeply have a need, who have a real benefit from working with us to come to us, and we want the others to be successful in their own paths.
I would just, since most of the people in this room are likely not going to raise money from any of us, honestly, I think the thing that I see is structurally one of the biggest changes has actually just been the information that exists in the market. Like TechCrunch is only 10 or 11 years old. AngelList is a relatively new property. The amount of market information is creating, to Rob's point, this when there's a bold idea, capital quickly chases it in this market. And so you're surprised when a company goes and raises 6 rounds in 18 months, or everyone knows about your company. But to me, actually, the amazing news for all of you is if you have traction, the market is so much more efficient. We are getting commoditized in a way. It used to be that we'd have lots of time to get to know founders before they would raise money, and now Y Combinator is giving us a week to meet with a company. They're meeting with 10 firms. They will get term sheets, and I actually think it's great for founders who know how to manage that process and still reach great decisions. But the efficiency in the market, to me, I think is fantastic for great founders, and to me, at the stage where many of the folks here are at, I think is really interesting and exciting, and that trend will continue.
Maurice said something I think that was also very important, which is there's many paths, And if you can build a business that's capital efficient, you want to choose investors who their investment returns are aligned with what your goals are as the entrepreneur. So a venture capitalist, he or she has his or her model where they're trying to get 3x on their fund to be great at their job and then be able to raise the next fund. But an individual doesn't necessarily need to get a 10 or 20x on an individual investment and have it be a great deal. So you might have different paths and different sources of capital, but I think that's going to be changing drastically. It's not that anything that, SoftBank may only fund a few companies. I think it's the secondary and tertiary impacts of what's happening when that big rock gets thrown in the pond. That's really interesting and how that will impact all of you.
Yeah, but just for the sake of being controversial, having been an entrepreneur, when anyone offers you money, you take it. Like, I don't see entrepreneurs saying they're not going to take money from CRV because they're aiming for a $50 million outcome instead of a $1 billion outcome. It just doesn't happen.
If you think it's a $50 million outcome, are you going to write that check? Are you going to write the check no. Are you going to write the check if you think it's a $50 million outcome or if that's what they want to do? The answer is no. That's not what your LPs want.
That's not what I will do, but if I offer the entrepreneur money, they will take it.
So you think an entrepreneur will take money from you knowing damn well that what they want doesn't align with your interest? That doesn't think very highly of the entrepreneurs.
I don't think you know. I think they want to build their business. In most cases, you don't know if your company is going to be worth $50 million or $1 billion. At least that's been my experience. Is that anyone else's experience?
It's such an opaque industry. I'm not sure that I, sitting across the table, knowing you for a week, have a real understanding of what you're seeking, or what I'm seeking, or what the path is going to look like. So I think it's sort of a strange argument to say that your values have to be completely aligned in terms of what your outcome is versus mine to make that decision to raise capital.
So maybe just building on that point, and I'm curious to get your opinion, and maybe I'll ask you first, Maurice, but clearly there's a lot of changes that are happening, and clearly this availability of capital is driving a new type of behavior. And if I think about the Israeli entrepreneurs, the biggest, or the most interesting thing that I see is the need to actually expand the vision and sort of go after those funds or any sort of Series A or Series B funds now in the Valley, because they know the downstream they'll need to fund companies that have the potential to become super mega home runs. So in your experience, how does that sort of change of behavior allows you to prepare your companies better into those fundraising opportunities? And basically, have you been seeing the opportunity to push your companies, for example, to grow faster, to grow through inorganic growth at times if the capital is available? And also, how does that actually play into that? Venture debt is also now is somewhat that I get a lot of questions from our entrepreneurs about, should they take that? How should they think about that? When is the right time to take that? Clearly, there are different players that, Silicon Valley Bank is clearly very different than WTI, but I think for the average entrepreneur, they don't know how to think about that. So how do you all think about it? And maybe we can start with Maurice.
I'll comment on a couple things, but with respect to what's different now, I think that entrepreneurs all have their heads down and they're building their businesses. And what we've seen through a few cycles over the past 20 years is that it's pretty important to be mindful of what's going on in the macro and always have capital availability. Your main job as a founder CEO is just to keep yourself alive. And the big joke we often say at WTI, it's sort of venture debt humor, but it's that running out of cash is what kills companies. So do not run out of cash. And even though right now there's lots of money flowing around, everybody saw the NASDAQ today, who knows what's around the corner next? It's extraordinarily important, I think, to be cautious from a financial perspective with respect to not running it too close to the red zone under all circumstances. And I think that really plays out in valuation. Even if you raise more money than you need, when you're raising that next round, when you still have a year of cash in the bank, it plays out in the way you're showing strength to prospective investors. You don't have to be fundraising. You can be a little bit more relaxed about those meetings that you're having, get to know CRV over a 6-month period, and I think it really works well. So I would say not to fine-tune valuation sensitivity, not to run it too close to the red zone, but instead just have cash in the bank and focus on execution, because you'll survive no matter what if you do that. So I think that, at WTI, there are a lot of changes. We're very worried about the risk of high valuations, and entrepreneurs sometimes shake their head and say, well, high valuations are great for me. They may not be good for you. They're not necessarily good for you either, because if you raise at a round that is maybe aspirational and you don't grow into those metrics, you're not going to be able to raise another round, and you may not even be able to get inside capital from your existing investors. Because really, truthfully, venture capital is just an option bet on the future. You think of us as wanting to buy ownership in companies, maybe notwithstanding Softbank, but for the most part, what the history of venture capital has shown is that investors are really just putting money to work and hoping that you guys execute well and they can put more money to work and ultimately it grows into a big outcome. But if it doesn't work, they're not really the most loyal people down the road forever. And that's the business we're all in, because we have to press our bets on winners and we have to cut our losses on losers. And I think it's really important to understand that dynamic, no matter how well you get along with the investors. And that's where WTI and all, I think, venture debt comes to play, which is to give yourself a little bit of supplemental cash, a little bit of cushion, a little bit of extra time. It can really matter. It can really matter. And just the question about SVB versus WTI. SVB, we think, is a terrific bank. They're very good at providing venture debt loans to their companies as well. They are a regulated bank, so they have different restrictions on how they can lend than we do. We're a private equity firm, and therefore we can put all of our money at risk and let companies draw their cash down to zero and use it totally and completely. So there are different types of capital, and they each have strengths and weaknesses. Ours is priced higher than theirs. It's also more flexible than theirs. And they're a terrific competitor to have in the market. I think we both keep each other quite honest.
Any other thoughts you wanted to add? Okay, perfect. I think just jumping to the next topic, and then I'm going to open it up. Lydia, you mentioned earlier the fact that you're really looking to add value, right? And a lot of what we're looking for when you're evaluating companies, whether you can actually add value to them through the network. And I think that's something that is very important to Masa-san in making investments and communicate it to all the portfolio companies. As I think most of the crowd here are actually entrepreneurs, and there's a lot of, I think it's very important to think about the value add around the table. How should they think about both selecting the right group of investors around the table when they're thinking about building the different rounds and going through different stages? And also, what have you found to be most helpful in actually engaging your investors and making sure that they are up to date, but also can add value to you? Maybe specifically to you, but also with regard to other investors on your board.
In terms of engaging your investors, your board, ask for help. It sounds really silly, but I think most of us got into this business because we want to help businesses succeed. We want to help founders. We want to help grow businesses in whatever way we can, and we're less capable of doing that than founders themselves. But I think everyone comes to the table with a belief that we can do something to help, and we like to be asked. So the companies that I work with most closely, it's because that founder is reaching out to me every week and saying, I need help on this. Help me out with that. And I love to take on those tasks. The founders who feel like they don't want to bother you, those are the founders I don't engage as much with. We think a lot about value add, and so we have a 500-person ops team that we're building just to help answer the questions that founders have. I need help hiring this person. I need this type of expertise. I need to plug in. I need to go talk to Apple tomorrow. We're building the expertise to help them do those big picture things. It's harder for smaller platforms to do. But I think every firm has their own idea about what their value add is. And I think in understanding who your investor should be, you should understand what do you think you need in the future and try and match that to the extent possible.
Yeah, I think the role we play is very different. I'd say in most cases, most of what we're doing is actually a statement of belief in the person. Like I joke, like your mom may love you, but she, in most cases, can't give you $10 million to go execute your idea. And most of the things we're investing in are so early. They're really huge, big statements of belief in the company, but also in the people. And a lot of my time gets spent both helping the CEO grow as a person into a role that is rapidly evolving, as well as seeing the company as the product and the evolution of the company into an organization. And having been an entrepreneur, I just remember, like, there's investors that you want to call and there's investors you have to call. I think we just try really hard to be that first call. When there's turbulence in the plane, we're the calmest in the room. I think a lot of the later stage investors are freaking out. A lot of younger people in their venture career are freaking out. I think that just takes getting punched in the face a lot, and working with a lot of founders and having been founders. I think that's where the relationship we try and work through. And And so for us, it's actually been harder to add a lot of value-added services around that, because I just got 2 phone calls from 2 of my founders, like during this panel. I can't outsource that to an associate or a head of talent. And that's also what I think we find super gratifying and why our team has basically stayed doing what we do.
And for us, we try to help entrepreneurs manage small amounts of money effectively and efficiently. When you're doing a $2-3 million round, how do you make sure you're going to accomplish enough to then be able to raise that next round of capital? We're all former operators, like much of the team up here, and so we want to help our entrepreneurs make original mistakes and not the mistakes that we made when we ran companies. And so sometimes you're opening a door to customers, sometimes you're helping with strategy, sometimes you're helping to design the engineering process and how they're running their agile system and everything else for the first time. Whatever kind of the entrepreneur needs, you do that. We tend to have regular check-ins with our entrepreneurs every other week. If they don't need it, give them a half hour back on their calendar. Sometimes they'll spend a half a day with us. And it ebbs and flows depending upon what the entrepreneur needs at that moment in time. The job is to be helpful without getting in the way.
Good. I think we can open it up. A lot of entrepreneurs, investors, executives in the room. Who wants to ask the first question?
Maybe it's the previous topic. Do you think, aren't you concerned that the rise of mega funds are kind of representing an increased aversion to risk in the valley and maybe in general in the venture capital industry?
What was the question?
Could you repeat the question?
Is the rise of mega funds going to lead to an aversion to risk? It represents an aversion to risk in Silicon Valley and across the planet. I think it's a risk if there aren't other sources of capital as entrepreneurs get started. But for all of our faults, Americans do one thing better than anybody else in the world, and that's optimism, right? And so I kind of have this naive belief that as long as we can attract people from all over the world here, and they believe that they have the opportunity to try and do something new, the younger generation is going to figure shit out. And so I kind of just have this belief that there's new things are going to continue to happen. I don't know what it is. If I knew what it is, I'd still be an entrepreneur. Instead, I'm a slimy, scum-sucking VC. The trick is to try to find the Katrina Lakes and the Mark Zuckerbergs before anybody else and give that person $1 million. And so I'm kind of more hopeful. I don't know what the economic constructs are going to look like. And I think that's going to be a big deal. And then people are going to have to be smart about thinking about how they capitalize their companies and what the sources of capital are. But I still have faith in humanity. I do.
I would just add, though, we see many of the folks that 10 years ago we thought were peers that moved into these mega funds. With bigger funds, they got distracted into later stage investing, which means it kind of left a big lane open for us and for a bunch of seed firms to take, we like risk, and when you move into growth funds, you just can't do that. You need revenue, you need product, you need growth. And so I think that has happened, but it's been displaced by a whole bunch of new capital and new firms.
I have a Softbank question. Might as well ask it. Do you guys look at returns and IRRs the way you think about investing your fund? Is there some sort of exit strategy for making money?
Yeah, I think it's something we actually think very deeply about, which is going to be surprising, it sounds like, to everyone in the room. Masa talks quite publicly about his historical return profile of 44% IRR over 25 years. He is very proud, and I don't know how much he's shared publicly or not, so I won't share any numbers. He's very proud that today our return profile is significantly above that 44% IRR. And so it helps by the macro environment that we're in, but I can give you lots of examples. Flipkart was our first exit in our fund. We had a big stake in NVIDIA, which has performed very well. And then the dozens of assets in our portfolio, which have been marked up by other investors at much higher valuations than our entry price. So we are benefiting from this great macro environment, but we're also benefiting from the massive trends in technology evolution that are just growing really big companies. And so I think at the end of the day, very rarely are we, if we're in competitive processes, very rarely are we the high price, very rarely. And I see people with much, much smaller funds shockingly come in at much higher valuations, marking up our assets 6 months later at 3 times what we paid. So I think we think deeply about returns. It's something we talk about on a monthly basis. I was in Tokyo yesterday talking about returns on a monthly basis. And we're excited to show the world that we can generate the scale of returns on this size fund.
Hey, a broader version of the previous SoftBank question. We see an order of magnitude increase, exponentially increase in the availability of capital for young, medium, and later stage companies. Are you seeing a similar order of magnitude or anything near that magnitude increase in the availability of exit or exit paths for companies? Are we not looking at an inflational process through which there's more money available, but not necessarily as many exit opportunities as it could entail?
There are, I think, two really important things. If you look at the latest data, we have a lot more capital has been deployed in many fewer deals that just came out and what was reported. At XSeed, our LPs, who are kind of fund of funds and endowments historically, have always said, don't take money off the table, let it ride, let it keep going, ride the appreciation. We're taking money off the table. I want to be really clear, especially as more and more of these mega rounds come in. If somebody wants to give us a 7, 8, 9, 10x, yeah, we'll take it, declare victory, lower our flag, and go home. Because we don't know when the music's going to stop. And by the way, gravity always comes back. Gravity always comes back. It's only a question of when.
Hi, my name is Yoav. I'm a partner at Stage 1, it's a seed fund on the Israel and Silicon Valley axis. And my question is very specific, and I almost feel shameful asking it in the presence of Softbank in the room. But to your point, Rob, we invest in two guys and a dog. One of the first decisions that need to be made is where to incorporate the company. A lot of the entrepreneurs here are Israelis on the Israel and Silicon Valley axis. There's been all kinds of trends shifting. Should you incorporate in Israel? Should you incorporate in the U.S.? So more to the earlier stage investors here. All other things being equal, because these guys have you in their crosshairs, in their aspirational crosshairs as the next level investors. All other things being equal, when you see a company, does it matter if they're U.S. incorporated or Israel incorporated?
I'll answer. I think our firm, my partner is from Israel. I think we're more comfortable than most. But generally, I think about reducing friction for investors. Like this week, God knows how many meetings I have with startups, and I have to make decisions about second meetings and third meetings and investments. And anytime you add friction to a process, I just think it just is going to create friction to an investment. So I guess on the margin, I would just say it's easier if the deal looks like every other deal. As soon as you introduce, you're not as complicated as an ICO or a token or something else, but you're also, just given the ADD that most venture capitalists have, it's just more time, it's more friction. You may end up getting passed over something very simple that you could easily fix.
Let's talk about the Israeli tax authority, who is currently sitting on millions of dollars of my limited partner's money. Okay, so I didn't think it mattered a lot until I had a decent-sized acquisition, and it sucks. So in the future, we're going to force the flip a lot sooner and a lot harder because we thought it didn't matter. In an upside scenario, I got to go to my LPs. Look, there's the money. They're causing us problems. Yes, it'd be a whole lot easier for us. And I know it's expensive and everything else, but even in an upside scenario, it's a pain in the ass.
So WTI's answer is we'll do both, but we far prefer U.S., and it's because of this reason. It's we will charge more for a company domiciled, and I guess I should say founded in Israel and located in Israel from the tax perspective, because we know that we're going to have to go through this sort of process. So we sort of gross up what we expect to be our returns, knowing it's going to get knocked back down. So at least with us, you'll get better pricing in terms if you're a U.S. company, but it doesn't mean we'd have the equal excitement about the business, but we'll price it differently.
We have limitations on where we can invest, and so we do invest heavily in Israeli-founded and backed companies, but they need to be domiciled here or in Canada.
All right, thanks.
You got your answer.
You're actually preaching to the choir, but it's great to hear it from the horse's mouth, so to speak.
More questions? We have only VCs asking questions. We need entrepreneurs.
If I have a plan for only $70 million, is there... I can't talk myself now.
No more questions? Oh.
Hi. areas where they invest in. In some areas, those collide in companies, right? So I just wanted to see, and I think that's relevant for all of you.
It's been extraordinary for me to just watch, especially with the agility and velocity of which the companies we back are growing. These companies are going horizontal in a way that perhaps other companies don't. But we find we don't mean to back in competitors, but we end up having a portfolio of assets that compete. I think we are open to it where they are not direct. I think it's inevitable they become competitive over time. There are some categories where we just won't do competitive. I think we work for instance, where we have our largest investments, we will not back competitors against them.
For us, at the time that we invest, we generally won't invest in competitors, and we'll try if we can. If we think that they are more foe than friend, we may try and have the CEOs connect. Ultimately, we'll leave decisions with our CEOs. So if our CEOs say it's competitive, we generally won't touch it. I think the more challenging issue we've encountered is sometimes a company pivots entirely into a lane of one of our existing companies, and then we do our best to try and limit information flow, separate board members, et cetera, if we can.
We're exactly the same. In fact, there was an icon company I met with yesterday who started to tell me his story. And I said, stop. Please look at this company right now and then decide if you want to continue going, because this isn't our portfolio. And it's just, all we have is trust. That's one of our differentiators. That's all we got.
We will invest in competitors, but we have every single company we've ever invested in on our website. And the moment we realize that we're talking to a company that might compete with one of ours, which is highly likely, we make sure they know that we're in that company. Unlike everyone else here, though, we're not taking board seats. We're not playing an active role from that perspective as an equity investor, so I think we play a different role in the ecosystem. And our best defense against the issue is just to make sure everybody knows every single company that we're in. And I think ultimately we're probably in a lot of competitive companies. We're probably in every single ad tech company out there, the good and the bad.
So I don't think there are sort of any more questions, but I guess you guys are going to hang out. Maybe before we finish, would love to get your sort of final thoughts as you think about Israeli entrepreneurs in the audience, thinking about some of them as sort of we're at different stages here. I think most of the folks here actually raise money. I think kind of like Series A, Series B stage. Any final thoughts as sort of they approach the US ecosystem and sort of start engaging with you personally? What are some of the things they should think about?
You guys keep looking at me. Yeah, it's all the haircut. Yeah.
I'll go first. We're looking to interact with all companies coming from Israel. We're very excited about the space, meaning the area, the geography, the opportunity. Hope to do more. We have an Israeli venture partner, Hagi Schwartz, and we've had terrific success working with companies coming here to the U.S. seeking capital, and so we hope to be a part of that with all of you.
We're actually spending quite a bit of time on the ground in Israel, particularly in areas like cybersecurity and autonomy. And so if you can take a look at the Softbank portfolio and understand how you would fit in and communicate to us how you fit in and add value across the portfolio and derive value, then we want to be talking to you.
I would say for us, we kind of have a bias towards Israeli entrepreneurs. They tend to be smart, aggressive, and in fact, it was funny, after I had my 4 meetings, my office hours yesterday with icon companies, I walked into my partner's office and said, I love meeting with Israeli entrepreneurs. It's kind of, there's no bullshit, you know what's going on, it's either fit or it's not. It's really kind of refreshing, to be honest with you. And so I think if you can get good, warm introductions, use the network to your advantage. I think you've got a very warm audience here. Just try to be aware and understand what are the motivations of the people on the other side of the table. How do they get judged about whether or not they're good or bad at their jobs, and see if there's an overlap in the Venn diagram. One thing I'll throw out, all the 5 of us here, we're all part of the same family. Like, we went to Stanford, we all know each other. A lot of the comments that we try to keep this lively, but understand we're all just part of the same spectrum of family, right? And so that's another thing about Silicon Valley. Israel's a small country, Silicon Valley's a small place, and everyone knows each other. So you run into people over and over and over again. This place is a multi-round game.
Yeah, I think I mentioned, I think we're somewhat unique as a firm in that I have a partner who's Israeli, who probably spends at least a third of his time in Israel. We have a lot of companies, and I can't think of many of our peer set that have a general partner. I think that's Israeli, that off the top of my mind. So I think it's easy to connect with us. I think we have an interest in Israel and Israeli founders, but I also would say on the community side, the easiest way to connect with us often, because we tend to be very founder focused, is if we don't know who you are, what your company was, what you've done, it gets hard for us just to interpret that signal. So the best thing for me is like when my cousin from Talpiot sends me an email saying like, you have to meet this guy or gal who was amazing, who did the following, who's starting a company, and that gets my attention. And it's those sorts of things, whether it's Dror or Shuli sitting back there, or someone that gives us some signal, I think really does mean a lot, because otherwise, just over an email, a cold email, we just often don't know what that, my partner sometimes does, but we often don't know what company they're talking about. If we do references, we don't know how talented the people in that company were. And so those proxies often really matter for where we're tending to get involved.
Awesome. I think we're out of time, actually. So thank you all for being very honest and sharing your thoughts.